ever feel like your tax return is just this uh, impossible puzzle? Like someone actually enjoys making it complicated.
Oh, definitely. You're not alone there.
But what if, maybe, understanding just a couple of key things could make it less baffling? And maybe even help you, keep a bit more of your own money.
That's the goal.
That's exactly what we're diving into today. We want to unlock the power behind individual tax deductions.
Right.
So our mission here is to really break down the two main kinds of deductions you'll see. The ones that are for your adjusted gross income and the ones that are from it.
Right. For AGI and from AGI.
And getting that difference, it's not just for CPAs. It can actually be a game changer for how you manage your finances all year long. All the content, examples, the explanations we're discussing, it's all derived from the great accounting resources over at farhatlectures.com. So whether you're maybe an accounting student studying for the CPA exam or already a professional, you could definitely check out the website. They've got extra practice questions, video lectures, tons of support to really reinforce what we talk about today.
It's really comprehensive stuff.
Huge thanks to Professor Farhat for providing all this valuable material for us to work with.
Absolutely.
Okay, so let's start big picture. Why should we even care about deductions in the first place?
Well, simply put, deductions are basically expenses for you, the individual taxpayer.
Like costs a business would deduct.
Exactly. But for your personal return. And the reason we love them is pretty straightforward. More deductions generally mean good news because they directly lower the amount of your income that's actually subject to tax. Every dollar you deduct, that's one less dollar the tax rate hits.
Ah, okay. So it directly shrinks your tax bill.
Precisely. It hits your financial bottom line. That's why understanding them matters.
Makes total sense. Lower the taxable income, lower the tax. But you mentioned there's a strategy to it, that not all deductions work the same way.
That's the crucial part. There's this fundamental split in the individual tax world. You've got deductions for adjusted gross income. People often call these above-the-line deductions.
Okay, above the line.
And then you have deductions from adjusted gross income, which are, you guessed it, below-the-line deductions.
And that line is actually, it's a real line on the tax form.
It is. It refers to the spot on your Form 1040, usually it's line 11, where you calculate your adjusted gross income, your AGI.
Gotcha. So AGI is the dividing line.
Exactly. And AGI itself is, well, it's a really key subtotal. Think of it this way. You add up all your income, first wages, interest, everything. Then, before you get to that AGI number on line 11, you subtract those above the line, or for AGI deductions.
Okay.
The result you get after those initial subtractions, that's your adjusted gross income. It's foundational for what comes next.
All right. So for AGI deductions, chip away at your total income before we even calculate AGI. What kinds of things fall into this above-the-line category? What are some common examples?
Well, a lot of them tie back to how you earn your income. Like if you run your own small business, your business expenses, revenue minus costs, that net income or loss calculation, that's already factored in before AGI. It's inherently an above-the-line adjustment.
Ah, okay. So it's baked in.
Right. Same idea applies to, say, farm income or income from rental properties, partnerships, S-Corp. The number you report for those activities has already netted out the relevant deductions. Beyond those business-related ones, there's a specific schedule, Schedule 1 on the 1040, that lists other common for AGI adjustments. Line 26 usually captures a bunch of these.
Like what?
Things like educator expenses if you're a teacher buying supplies, contributions to an HSA, a health savings account, penalties if you had to withdraw savings early, certain deductions for traditional IRA contributions, even things like jury duty pay you have to turn over, or the non-taxable value of Olympic medals, believe it or not.
Wow, okay. So a real mix of things.
Yeah, but the key is they all reduce your income before you hit that AGI calculation.
So they're like the first wave of deductions. They get subtracted right off the top, which brings us back to AGI itself. Why is landing on that specific number such a big deal? What's the strategic importance?
This is where AGI gets really interesting. It's not just a middle step. It acts like a gatekeeper for certain other deductions.
A gatekeeper? How so?
Because your AGI figure directly impacts the calculation for some major itemized deductions, those below-the-line ones we haven't talked about yet. Many of those have percentage limits based on your AGI.
Percentage limits? Like you can only deduct up to a certain amount
Mm-hmm.
or over a certain amount?
Usually it's an over threshold. Let's take medical expenses. That's a classic example. Right now, you can only deduct qualified medical expenses that exceed 7.5% of your adjusted gross income.
Oh, okay. So there's a floor you have to get over.
Exactly. So let's say your AGI is $100,000. That 7.5% floor is $7,500.
Right.
Now, if your actual medical expenses for the year were, say, $6,000, you don't get to deduct anything because
Yeah.
you didn't cross that $7,500 threshold.
Makes sense.
But if your expenses were $8,000, you did cross the threshold. You can deduct the amount over the floor, which is $500 in this case, $8,000 minus $7,500.
Wow, okay. That really shows how AGI matters. A lower AGI would mean a lower floor, right?
Precisely. If your AGI was only $60,000, the floor would be just $4,500, 7.5% of 60K. So that same $8,000 in expenses would suddenly yield a $3,500 deduction.
That's a huge difference. So AGI isn't just some number. It actively controls your access to other potential deductions.
That's the power of it. It sets the stage.
Okay, so once we've calculated that crucial AGI number, what happens next? We move below the line to those from AGI deductions.
Exactly. After AGI is nailed down, you basically face a choice for taking deductions from that AGI number.
A choice.
Yes. You have two main options. You can make the standard deduction, or you can itemize your deductions.
Standard or itemized, and you just pick one.
You pick the one that's greater. Whichever option gives you the bigger deduction, that's the one you take. It's purely about maximizing your benefit.
Okay, let's break those down. What's the standard deduction?
The standard deduction is basically a no-fuss amount that the government gives you. It's designed to make things simpler for a lot of taxpayers. The amount is fixed, but it changes each year, usually goes up a bit with inflation, and it depends heavily on your filing status: single, married filing jointly, head of household, etc.
So you just look up the amount for your status for that year.
Pretty much. For example, in 2022, just to give you a ballpark, single was around $12,950, married filing jointly was about $25,900, and head of household was near $19,400. But definitely always check the current year's figures.
Got it. Fixed amount based on filing status. Is that always it for the standard deduction?
Not quite. There are also additional standard deductions available for certain people.
Oh, like bonuses.
Sort of. You can get an additional amount added to your basic standard deduction if you are age 65 or older.
Okay.
Or if you are legally blind.
Ah, one or the other.
Or both.
All right.
If you happen to be, say, 70 years old and blind, you actually get 2 additional standard deductions stacked on top of your basic one.
Wow. How much are those?
Again, it changes, but for 2022, for a single person, each instance being over 65 or being blind added about $750 a day. For married folks, it was around $1,400 per instance.
So that can significantly boost the standard deduction amount for older or visually impaired taxpayers.
Absolutely. It makes the standard deduction a much higher bar to clear if you're thinking about itemizing instead.
Okay, so that's the standard deduction, potentially with additions. What's the other path? Itemizing.
Right. Itemized deductions are where you don't take the fixed amount. Instead, you track and add up specific eligible expenses throughout the year. You list these out on a separate form, Schedule A, that attaches to your Form 1040.
And what kind of expenses can you itemize?
The common ones include those qualified medical and dental expenses we talked about, but only the amount exceeding the 7.5% AGI floor. Also, certain taxes you've paid, like state and local income taxes or property taxes, though there's currently a cap on that, often called the SALT cap.
Okay.
Qualified interest you've paid, like home mortgage interest is another big one. And gifts to qualified charities. There can be others too, like casualty losses in some situations.
So you add up everything you're eligible for on Schedule A.
Correct. You sum up all your potential itemized deductions, then you compare that total to what your standard deduction would be.
And take the bigger number.
Take the bigger number. Simple as that.
Let's try an example. You mentioned David and Sarah earlier, married filing jointly. Let's say they calculated their itemized deductions, maybe mortgage interest, property taxes, some charity donations, state income taxes, and it all adds up to $26,900.
Okay, $26,900 itemized.
And let's use that 2022 figure, where the standard deduction for married filing jointly was $25,900.
Right, so they compare $26,900 itemized versus $25,900 standard.
The itemized is higher.
Yep, so they choose to itemize. They get an extra $1,000 deduction that way, which lowers their taxable income more than the standard would.
Makes sense. Now, what about Sarah? But let's say she's single and 65 years old.
Okay, single 65.
Let's say her itemized deductions, maybe less mortgage interest, whatever her total, only $13,500.
All right, $13,500 itemized.
Now we compare that to her standard deduction. The basic single amount for 2022 was $12,950. But wait, She's 65.
Ah, good catch. So she gets the additional standard deduction. For single in 2022, that was $7,750.
So her total standard deduction isn't just $12,950, it's $12,950 plus $14,700.
Exactly. Her enhanced standard deduction is $14,700.
So now she compares her $13,500 itemized total to that $14,700 standard deduction.
And the standard deduction is higher.
So she takes the standard deduction even though she could itemize $13,500 worth of stuff.
That's right. The standard deduction gives her a better outcome. That additional amount for age really tipped the scales there.
Those examples really clarify the choice. Are there any situations where you can't take the standard deduction even if it's higher?
Yes, there are a few important ones. A common situation is if you're married, but you file separately from your spouse.
Okay.
If your spouse chooses to itemize their deductions on their separate return, then you generally cannot take the standard deduction. You'd likely have to itemize too, even if your itemized amount is very small, or zero.
Oh, interesting. So married filing separately, couples need to coordinate that.
They really do. Another group typically barred from the standard deduction is non-resident aliens.
Got it. And you mentioned something earlier about exemptions, personal exemptions. Are those still around?
Good memory. Yeah, personal and dependency exemptions used to be another type of from AGI deduction. You got one for yourself, your spouse, each dependent. However, the Tax Cuts and Jobs Act back in 2017 suspended these exemptions entirely from 2018 through 2025.
So they're gone for now.
For now, yes, they're currently scheduled to potentially come back in 2026, unless Congress changes the law again. It just shows how these rules can shift.
Definitely something to keep an eye on. Okay, one more specific group. Dependents. You mentioned personal exemptions are gone, but can dependents still take a standard deduction if they have to file their own return? Like a teenager with a summer job.
Yes, they can, but the rules for calculating their standard deduction are different from the normal rules. It's a bit tricky.
How does that work?
For someone claimed as a dependent on another person's return, their standard deduction is the greater of two amounts. Option 1 is a flat minimum amount, which was $1,150 in 2022.
Okay, $1,150 minimum.
Option 2 is their earned income, like wages from that summer job, plus a certain additional amount, which was $400 in 2022.
So earned income plus $400.
Right. They calculate both, the $1,150 minimum and their earned income plus $400. They take whichever of those two is higher.
Okay, greater of the minimum or earned income plus $400. Is that it?
One more crucial piece. There's a cap. The dependent's standard deduction, calculated this way, cannot exceed the basic standard deduction amount for a regular single taxpayer.
So it's capped at the single standard deduction amount, like that $12,950 figure for 2022.
Exactly. So it's greater of $1,150 R, earned income plus $400, but no more than $12,950 using 2022 figures.
Let's walk through an example. Say a child is claimed as a dependent. Maybe they're blind but have no earned income.
Okay, no earned income. Their standard deduction would normally be the greater of $1,150 or $0 earned income plus $450.
So $1,150.
But they're blind. Do they get the additional standard deduction?
Yes. The additional amounts for age and blindness do apply to dependents as well. So that blind child gets the basic $1,150 plus the additional $750 for blindness using the 2022 single rate. So their total standard deduction is $1,150 plus $1,750, well, $2,900. Wait, I think the source said $2,650 for a blind child with no income. Did I miscalculate? Maybe the source used the $1,150 already, including the $400 check. Let me rethink. Wait, no, the base is $1,150 R plus $400. The source example must have a typo or maybe use slightly different base numbers. Let's stick to the formula. $1,150 base plus $750 additional equals $2,900 seems right based on the rules we discussed for 2022.
It's possible source examples use slightly different year figures sometimes. The key is the formula logic. Let's try another based on that logic. What if a dependent child earned $1,500 from a job?
Okay, earned $1,500. We compare $1,150, the minimum, with $1,500 earned income plus $400.
Right, which is greater.
$1,900 is greater than $1,150.
So their standard deduction is $1,900, and since $1,900 is less than the single cap, $12,950, they get the full $1,900.
Okay, one more. What if a dependent student earns quite a bit, say $13,800?
All right, $13,800 earned income. We compare $1,150 minimum with $13,800 plus $400 and $14,200.
$14,200 is greater than $1,150. So is their deduction $14,200?
But remember the cap.
Oh, right, the cap. The maximum is the single standard deduction, which was $12,950 for 2022.
Exactly. So even though their calculation came out to $14,200, it gets limited. Their standard deduction would be capped at $12,950.
Got it. Those dependent rules are definitely specific. Understanding those little nuances seems like it could really matter for families with working kids or students.
It absolutely can. It affects whether they owe tax or how much.
Wow. Okay, so just to recap quickly, we talked about why deductions matter. They lower taxable income.
Right. Less tax overall.
We drew that critical line between, for AGI deductions taken before calculating adjusted gross
And
income,
the above the line ones.
and from AGI deductions taken after AGI.
Below the line, which means deciding between standard or itemized.
And we saw just how important that AGI figure itself is, acting as that gatekeeper for certain itemized deductions like medical expenses.
Yeah, its impact is significant.
And then we dug into the standard versus itemized choice, saw how the additional deductions for age blindness work, and even tackled the unique rules for dependents.
It's a lot, but understanding those core concepts is huge. So thinking about all this, maybe a final thought for you listening is, how might really getting a handle on these deduction categories, especially that AGI gatekeeper role, change how you approach your own financial planning? Or even just how you track expenses during the year?
That's a great question. It feels less like just reacting at tax time and more about, proactive strategy throughout the year.
Exactly. It connects tax planning to your broader financial life.
Absolutely. The more you understand these gears turning, the better you can manage things. We really hope this deep dive helped clarify some of that. We definitely encourage you to explore this more. Maybe look at your own past tax return with these ideas in mind. See where the numbers fall.
See if you took the standard or itemized. Look at your AGI.
And as we mentioned, if you want to dive even deeper, get more examples, practice questions, really solidify this stuff, head over to farhatlectures.com.
Professor Farhat's resources are fantastic for reinforcing these concepts.
Definitely worth checking out to empower your financial knowledge. Thanks for joining us on the deep dive.